The world woke up to a shock. Overnight, a dramatic event sent ripples through global markets, catching investors and everyday people off guard. Oil prices have surged a staggering 7% overnight, marking the biggest single-day jump since the Ukraine war began in 2022. This sudden spike has left analysts scrambling for answers and consumers bracing for higher costs at the pump. The cause? Escalating conflict between Israel and Iran. Tensions in the Middle East have reached a boiling point, and markets are on edge, fearing that Iran could move to disrupt the vital Strait of Hormuz, a strategic choke point for global oil shipments. This narrow waterway is the lifeline for global oil, with nearly a fifth of the world's supply passing through it every day. Even the mere threat of its closure is enough to send oil prices soaring, as traders rush to hedge against potential shortages. History shows that Middle East conflicts can hit the global economy hard. Think back to the 1973 oil embargo, which triggered gas lines and recession, or the 2019 tanker attacks that rattled markets and sent prices climbing. Now, both Brent and West Texas oil futures are spiking, with energy stocks rallying as investors bet on higher profits for oil producers. The shockwaves are being felt across financial markets worldwide. Meanwhile, fuel-dependent sectors like airlines are tumbling as rising oil prices threaten to squeeze profit margins and drive up ticket prices for travelers. The market is gripped by fear and uncertainty, with investors pricing in worst-case scenarios, from missile strikes to naval clashes that could further disrupt oil flows and destabilize the region. The key takeaway? Right now, it's not just supply and demand, but the looming threat of conflict and the uncertainty it brings that are driving oil prices to new highs. The Strait of Hormuz is the world's most critical oil choke point, an incredibly narrow waterway that connects the Persian Gulf to the open ocean. Just 21 miles wide at its narrowest point, it's a vital artery for the global economy, serving as the main route for energy exports from the Middle East. Every day, about 20% of global oil, roughly 21 million barrels, flows through this channel. That's nearly 1 out of every 5 barrels consumed worldwide, making it a lifeline for both producers and consumers across continents. Any disruption here would send shockwaves through global supply chains, halting shipments and triggering immediate price spikes. The ripple effects would be felt from gas stations in Asia to factories in Europe and the Americas. A full closure could plunge the world into recession, as energy prices soar and financial markets tumble. The economic consequences would be swift and severe, affecting millions of jobs and livelihoods. Iran's control of the strait gives it enormous leverage over the global economy. Even the mere threat of disruption is enough to rattle markets and unsettle governments worldwide. The US and other world powers have long protected this vital artery, maintaining a strong military presence to deter conflict. But with rising tensions, the risk of confrontation is now front and center. The world is on edge, watching every development in the region, knowing that any escalation could have dramatic consequences for energy security and the global economy. Investors are watching 3 critical red lines, key warning signals that could send oil prices soaring past £100 a barrel, a level not seen in years. The stakes are high, and every move in the market is being scrutinized by analysts, traders, and governments alike. The first trigger is a confirmed attack on oil infrastructure, whether it's tankers at sea or major production facilities on land being hit by missiles or drones. Such an event would immediately disrupt supply and send shockwaves through global markets. The second red line is a direct military confrontation between Iran and Western forces. If open warfare breaks out, the risk to oil flows from the region would skyrocket, and prices could surge overnight as uncertainty grips the market. The third and perhaps most dramatic risk is any physical disruption of the Strait of Hormuz. Even a brief closure, just a few days, would halt the passage of 21 million barrels of oil per day, sparking chaos and panic across the globe. If any of these scenarios unfold, panic buying and wild price spikes are almost certain. The ripple effects would be felt not just in oil markets but across the entire global economy. Right now, the market is on high alert, bracing for the next escalation. Every headline, every movement in the region is being watched for signs that one of these red lines might be crossed. As tensions simmer, the world waits to see if oil will break through the 100 pounds barrier, and what that could mean for everyone. In this volatile market, investors must act. Winners, energy stocks, oil producers and refiners benefit from higher prices. Losers, airlines, shipping, and industries with high fuel costs. Now's the time to review your portfolio. 3 steps. 1. Add exposure to quality oil producers or energy ETFs. 2. Hedge your risk. Don't be overexposed to vulnerable sectors. 3. Trim holdings in fuel-sensitive industries. This isn't panic selling, it's smart risk management. Position yourself on the right side of this crisis to protect your capital and navigate the storm ahead.